Dear students of the MBA program of the School of Business, Bangladesh Open University, Assalamu alaikum. I welcome you all in today's program. Today I would like to present my topic on sales mix from CVP analysis, and thus the title is CVP analysis emphasis on sales mix. I have selected today's program from the course Managerial Accounting MBA 2309. Though the topic has been selected for the students of MBA program, however, the students of the BBA program will also be benefited from this presentation. At first, let us try to understand what is meant by sales mix. The term sales mix refers to the relative proportion in which the company's products are sold. When an organization sells multiple products, it should try to achieve such a combination that will achieve the greatest amount of profit. Thus, the sales mix to some extent affects the profit of an organization. Dear students, you know that under CVP analysis, cost is classified according to cost behavior, that is variable cost and fixed cost. Contribution margin is the amount remains after variable expenses are deducted from sales. For a particular product, if the contribution margin is higher comparing to the contribution margin of another product, we call it high margin product. On the other hand, if the contribution margin of a particular product comparing to the contribution margin of another product is less, we call it a low margin product. Profits will be higher if high margin than low margin products make up relatively high proportion within the total sales mix. Changes in the sales mix can result a perplexing situation or variation in company's profit. A shift in the sales mix from high margin product to low margin product can reduce the total profit of an organization, however, increasing the total sales for the organization as a whole. Conversely, a shift in the sales mix from low margin product to high margin product can increase the total profit of an organization, keeping the total sales same or decrease. Dear students, now let us look at an example to understand the term sales mix. XYZ company's total sales under a given situation are $100,000. It produces and sells 3 products: product A, product B, and product C. If the total sales revenue of A is $20,000, B $30,000, and C $50,000, the sales mix is A 20%, B 30%, and C 50%. The managers must understand the impact of sales mix on overall profit of the organization. To understand today's topic more elaborately, I have selected a problem from our reference textbook. It is problem number 625 on page 264, chapter 6 of the 11th edition of Managerial Accounting by Garrison, Norrin and Brewer. Here we are provided with a budgeted income statement of Gold Star Rice Limited. The Gold Star Rice Limited sells 3 products. One is white, another one is fragrant, and the third product is Lunzaine. Look at the sales mix or the percentages. It want to sells 20% of white, 52% of fragrant, and 28% of Lunzaine. You can understand, since the percentage of fragrant is the highest, which is 52%, it must be the high margin product. And since the sales of white is only 20%, it must be the lowest margin product. Now look at the variable expense ratio. The variable expense ratio of white is 72%. And the contribution margin ratio is only 28%. So you can understand this is the low margin product with high variable cost and low contribution margin. On the contrary, fragrant is the high margin product which contributes 80% and the variable expense ratio is only 20%. For Lunzaine, which is in between these two products, for this product the variable expense ratio is 40% and the contribution margin is 60%. The overall total variable expense of the organization is $270,000, which is 36% of sales, and the total contribution margin is $480,000, which is 64% of sales. The total fixed cost is $449,280. So there is a net operating income of $30,720 as per the budgeted income statement. According to this data, as we compare the break-even point in dollar, we can get $702,000 as the break-even point. Now, let us assume that when the company makes the actual sales, there is a shift or change in the sales mix. The total sales of white has been increased to $300,000. That means that it has been increased from 20% to 40%. The sales of fragrant, which is the high margin product which has 80% contribution margin and 20% variable cost, the sales of fragrant has been decreased only to 24%. The next product, which is Lunzaine, its sales has been increased from 28% to 36%. As a result, as you can understand, that the sales of low margin product has been increased and the sales of high margin product has been decreased. The total variable cost of the organization as a whole has been increased to $360,000. As a percentage, it is 52%. And the contribution margin for the organization as a whole has been reduced to $390,000, and the overall contribution margin has been decreased to 48% only. However, since the fixed cost is remaining same, the decreased amount of contribution margin is not enough to cover the fixed cost. As a result, a net operating loss occurred for the organization as a whole. On the basis of the actual data, as we calculate the break-even point in dollar, we can understand it has also been increased. It is increased to $936,000. Dear students, as you can understand, as we compare the actual income statement and the budgeted income statement, what we can understand, variable expense changes in total with the change in the level of activity. As we understand the actual sales, there is a negative shifting in the sales mix. That is, the sales of low margin product has been increased and the sales of high margin product has been decreased. As a result, the total variable expense for the organization as a whole has been increased and the total contribution margin for the organization as a whole has been decreased. Look at the comparative statement between the budgeted data and the actual data. What you can see. Dear students, let us look at a table that shows the comparative analysis of budgeted data and actual data. The total budgeted sales and the total actual sales are same, you can see. However, since the sales of low margin product has been increased, as we consider the actual income statement, you can understand that the total variable cost has been increased compared to the variable cost on the basis of budgeted income statement, which is $270,000 for budgeted income statement and $360,000 for actual income statement. As a result, the total contribution margin has been decreased for the actual data, which is $390,000, which was actually $480,000 for the budgeted income statement. The overall variable expense ratio has been increased from 36% to 52% as we compare the actual income statement with the budgeted income statement. And the overall contribution margin ratio for the organization as a whole has been decreased from 64% to 48%. Dear students, you can understand that the negative impact on the financial condition happened because of the changes in sales mix in a negative way. That means the sales of high margin product has been decreased and the sales of low margin product has been increased, keeping the total sales same as compared to the budgeted data. Therefore, the managers must try to make the sales mix in such a way that it has maximum of high margin product and the minimum of low margin product, thus keeping the variable expenses low and contribution margin high, and provide maximum profit for the organization as a whole. Dear students, I hope that the concept of sales mix and its impact on profit has become clear to you, and you can understand that it is the concept of high margin product and the low margin product which depends on the price of sales and the variable expenses, that is the contribution margin ratio. For further details, please read your text and the reference book. No more today. Allah Hafiz.